I'm guessing most of us are financial advisors. There's clearly some guys from the product providers here. But just a show of hands, of the financial advisors in the room, how many use platforms? A good 70%. How many would use managed funds? About the same. What about direct equities? Oh, about the same. And property, direct property? A couple, maybe 10%. And what about ETFs? About 25%. Okay, that's a good sense of where we're coming from. Just bear with me on the technology side. Okay, that's my disclaimer. Please take the time to read it. Right, we've done that. Right, a little bit of background of our journey. I'm second generation in our financial planning practice. Over the last couple of years, we've gone on a journey that has had three main phases. Firstly, on the IT side, our business has moved from traditional platform-based business towards more self-managed super fund and ASX. By that I mean ETFs and direct shares to facilitate that. On the fee side, we've shifted from a percentage of assets and commissions on insurance to purely fixed cost quote provided to the client up front. And on the business management side, our father established the business, and my sister, who is ex-PwC and Macquarie Bank in structured products there, and I are the principals of the business moving forward. So we've been on quite a journey over the last couple of years, in the same way that Brett and Russell have been as well. A little bit about myself. I've got some financial qualifications. My background is predominantly investment banking in London, New York, and Australia. Roles I've held include a sell-side analyst, so I 24/7 used to follow direct equities, day in, day out. I was lucky enough to spend some time both in New York and London, spent some time on the New York Stock Exchange floor, so I get share trading. I love it, I'm passionate about it. I was also lucky enough at one stage to be a property analyst, so I get property, I love it. You can touch it, you can feel it, clients love it. And I also spent some time at Deutsche, including time launching a couple of managed funds. So I get managed funds as well. I can see the benefit to clients, as you do, undoubtedly in this room as well. So if anything, my bias is probably not towards ETFs, it's from those other investing routes. Oops. Right, having said that, our clients love direct share trading. They get home each night, they turn the news on, and there's Alan Kohler telling them the little stories about what's happened during the day on the ASX, and his little graph of the week. They spend their Saturday afternoons at friends' barbecues exchanging investing stories and how much money they've made or lost on BHP, Rio, so on and so forth. They get share trading, they like it, it's exciting. Having said that, when it actually comes to the share trading, there's a lot of work and administrative hassle involved in that actually adds very little to your overall return. So, clients understand the companies, they see them, they deal with them, they see them on the high street, but there's a lot of extra work, and we as advisors are aware of that. And that's a true cost to our business, and it does nothing to the actual overall returns for the client. So there are weaknesses inherent in that approach. The managed fund side. Now, I'm a simple person, and I, over recent years, have struggled to pick the best performing fund managers year in, year out. I thought, well, let's look at the awards. Who gets the awards? Now, the awards seem to be very highly correlated to past returns in the last year. When you look at the correlation between those awards and then future returns, when you look backwards after the event, the correlation is nowhere nearly as strong. So, in our business, we struggled year in, year out to actually pick those 25% of those funds that would outperform. Plus, they changed. In fact, some studies have shown you're almost better to pick the bottom 25% with reversion to the mean. They're going to come back up again. So, there's some of the issues that we faced. I was probably a little bit better at aiming than there, but I did struggle to hit the middle, the sweet spot. So, that leaves us with a question, passive or active? Another hands up exercise for you. Who's a rugby fan in the audience? Right? About 25%. Who's a rugby league fan in the audience? Ooh, about 35, 40%. Okay. I grew up playing rugby. I went to a rugby school. I played it overseas. West Tigers courses through my veins, through my father, who played for them. So having said that, nearly every rugby league fan that I know detests rugby union. They can't see the attraction in it. And every rugby union fan looks down on rugby league, who can't see the attraction. I'm in the middle, where I can see the attraction between both. There are strengths and weaknesses to both approaches to basically how you thump each other with a ball, right? Both have got strengths and weaknesses. So too when it comes to active and passive. The number of active guys that I know that say passive is a dumb game, it's a stupid game. You know, you're wasting money up against the wall. They don't know what they're doing. And the passive guys say, well, active's a waste of time. Yeah, they might outperform, there might be some alpha there, but they capture that alpha with the fees and with the taxes, the excess taxes, because they're trading too often. And the distributions they're throwing off are not tax effective. And when you look at the after-tax returns, then it's not worth it. Now, they're very different arguments, and I can see the strength in both. I don't know which one's right. Do you guys? Does anyone in here know which is the right approach? You'd have to be a brave person to actually claim that. So, having said that, we play it down the middle. We try and take the best of both, take the strengths and weaknesses of both. And I think it's been mentioned by a couple of people already today, and that's core and satellite. We allocate a portion of the portfolio to passive, low-cost, diversified investments. In the past, they were index funds, unlisted. Now, increasingly they're ETFs. And then we overlay that with best of breed, high conviction ideas that we've got. They're not mutually exclusive, and they can gel very, very well together.